My name is Jacob Shelton. I'm an international financial advisor with Holborn Assets, and I specialize in helping American expats navigate the complexities of cross-border finance, tax compliance, and long-term wealth planning. I've been a financial advisor for a little over a decade, mostly back in the US, working for firms such as Morgan Stanley and JP Morgan, both in Portland, Oregon. I also have my master's in finance from the University of Arizona, and I am a global financial planning fellow with the Global Financial Planning Institute. I currently live in Valencia, Spain, with my wife, and who is actually pregnant. We're expecting our first son this March, so just about 2 months from today. But we've been through the same process as the move, right, from the States to the EU that many of you are contemplating now or have already made the move yourselves. But whether you've recently relocated or have been living in Europe for potentially years, today's session is designed to give you some actionable insights to protect and grow your wealth abroad. Below, you'll find a button in order to submit a question for the Q&A session at the end of the presentation today. However, there already have been a bunch of questions that were submitted beforehand, and I want to try to answer as many as possible. So I might not necessarily be able to get to yours. Some of those were simply that people had too many questions to ask in the given characters. So there's also going to be a QR code during the Q&A session with a link to book a free consultation directly into my calendar. The presentation will also be recorded and posted on the Holborn YouTube page. So I'll make sure that everyone who registered will be sent a link in case they would like to refer back to the information we discuss or simply weren't able to make the live session. So let's go ahead and jump in. So living abroad opens up some incredible opportunities, but it also introduces some complexity. As a US citizen in the EU, you're subject to 2 regulatory systems, 2 tax regimes, and often limited access to familiar financial products and services. Now, one note on this presentation is it's not country specific. I do quite a few country specific presentations as well. So please send me an email if you'd like a schedule for the next webinar for your country. Coming up next month in February 2026 is a Moving to France webinar with an immigration specialist. And later in the month is a Buying a House in Spain with a mortgage specialist that focuses on expats looking to purchase a property in Spain. But most of these challenges that you might face are realities in no matter which country you reside in. For one, you most likely don't have access to the previous financial advisor that you used back in the States. On top of some of these challenges, you're unable to take advantage of some of the various country-specific products that non-US expats take advantage of. And of course, a huge issue this past year, the exchange rate risks that we've seen. So we'll touch on all of these here today. But again, for a more in-depth look in your own situation, I see quite a few people more rolling in just a couple minutes late. So please feel free to use that Q&A button. But also there will be a QR code to book a consultation with me during that Q&A session. So in the EU, financial regulation varies country by country, although there are some overarching regulatory bodies. But many US-based products, such as mutual funds, are restricted due to FATCA and PRIPS. So I know that there's going to be a few acronyms today that if you're not in the industry, you might not necessarily recognize. FATCA is going to be a set of US regulations that concern investments, of how US citizens can put their assets abroad and some of those reporting standards. PRIPS is actually a set of regulations from a European regulatory body, but just means packaged retail investment or insurance-based product, also known as mutual fund, and some others that are going to be similar to mutual funds, which is really under the regulatory body of MiFID. You might not necessarily need to know those, but it's why working with an advisor that's regulated in your country of residence is critical so that they are able to keep you compliant, which is exactly what we do. And we help clients identify some high quality compliant alternatives to these products that we no longer have access to once you do have a foreign address. So But as we identify these alternatives, we still need to be extremely aware to avoid PFICs. And PFIC is certainly an acronym that you should remember no matter what. It is passive foreign investment companies. So think of it at like a foreign mutual fund or ETF. The IRS taxes these at much higher rates, and it can be extremely high filing costs with your CPA if you do have a PFIC as a part of your portfolio. So we need to make sure that you don't have those. Otherwise, your CPA will come find me. And cross-border planning isn't always just about growing your wealth, it's about protecting it. So one of the obligations that we have as a US expat, we must comply with some of these IRS reporting requirements. The FBAR is going to really be one of the large ones, which applied to accounts that had at least 10,000 or USD or equivalent at any point in the year that's going to not be in the United States. And we also need to adhere to some of these local EU reporting regulations. Here in Spain, one that's an annual reporting requirement is the Modelo 720, which is any asset that you have outside of Spain that has at least 50,000 euros or equivalent in that. And so we need to make sure that we're being compliant in the US and in your new country of residence. Penalties for non-compliance on either side can be very severe. So proactive planning and proper reporting is key. Fortunately, we don't have to pay taxes necessarily on both sides, although we do still have to file on both. The US has tax treaties with many EU countries to help avoid this double taxation. So when we go back and file our 1040s in the US, you might be eligible for foreign tax credits, foreign housing credits, the foreign earned income exclusion, or treaty-based exemptions. But these benefits aren't necessarily automatic. You need to claim them properly and record them properly from when we file. Once you're an expat, you typically file in your new country of residence first and take some of these credits back to the US to eliminate, ideally, your US tax obligations. Some countries' dual tax agreements with the US are much more favorable than others. France is a great example that really favors US retirees living off of investment income, either from brokerage or retirement accounts. But that same dual tax agreement doesn't necessarily favor earned income. And so that's where we need to make sure, right? And that can be part of the planning process before you actually make the move as well. I go through that with quite a few people of what country makes sense and why, because of these dual tax agreements. Sorry, I did skip that slide. So let's shift to investments, which is my specialty. Expats often face limited access to US brokerage accounts, so it's important to build a globally diversified portfolio using compliant firms that are able to custody assets either in the US or globally if that's your desire. I will say I've had the requests to move assets outside of the US far more than I ever have in the past. In 2025, I'm sure many of you watching today can probably guess why. But we are certainly able to do so, although there can be some additional compliance and potentially additional costs. But we focus on, in our strategies, multi-currency diversification, risk-adjusted asset allocation, and tax-efficient structures. So our goal is really to help you grow your wealth or maximize income while minimizing exposure to market volatility and tax drag, especially now that you might be living in a higher tax jurisdiction. And of course, market volatility. The world's a little crazy right now. So we want to make sure that maybe your investments don't always reflect that same type of volatility. Speaking of volatility, currency fluctuations can have a major impact on your returns. It's funny, last week I built out a euro-focused portfolio, but the account was dollar denominated. And so the client was shocked at that 1 year return being almost 30% when it's shown in USD. So I had to remind them that 15% of that was just the exchange rate difference. But diversifying across geographies and currencies we can help clients reduce some of this currency risk and stabilize long-term performance. This is especially important for those earning in euros but planning retirement in dollars or vice versa. So one of the biggest ways that we can help reduce currency risk is ahead of a large purchase, particularly a home. The best way to do this is through a forward contract. We work with multiple currency partners for this, such as Smart Currency Exchange, Spartan FX, or even Wise will have this capability by the end of the year. But it essentially locks your exchange rate for up to 12 months in advance. And so that, if we're buying a €500,000 property, we might want to lock 250,000 euros of that in advance so that we're able to continue our investments in our American accounts, but make sure that we're not having to pay 15% more if this is the same scenario as last year for that home. Retirement planning's expats can require integrating U.S. accounts like IRAs, 401ks, 403bs, 457s, or really the alphabet soup of U.S. retirement accounts with local pension schemes if they make sense and if you qualify. But we help clients maintain the U.S. retirement accounts compliantly to evaluate some of the pension options in their new country of residence, particularly if they're working and if it makes sense, as opposed, and, do they want to be a salaried employee? Do they want to be a consultant or, self-employed, similar to a 1099? Do they need a local company that's going to be more acting along the lines of maybe a US LLC? We definitely take a look at some of these options and maybe even where those countries, what country we wanted to use for those different companies. And so we definitely go through a lot of that planning with clients. If you're self-employed and about to make the move, definitely book a consultation because we want to go through really that full gamut of options. But at the end of the day, we build hybrid strategies that align with clients' retirement goals. It's not just about the saving of the employment income. It's about optimizing some of these withdrawals at the end of the day, minimizing taxes, and ensuring that you retain access. Now, many expats ask, should I keep my U.S. retirement accounts? The answer depends on your residency, tax status, and long-term plans. So we guide clients through rollover options and structuring assets properly, distribution strategies, including Roth conversion planning, cross-border tax implications and planning, so you can make informed decisions that support your lifestyle and legacy. And speaking of legacy, the estate planning. It's often overlooked, but it's extremely important for expats, particularly if you're looking at France. Both Portugal has 0% inheritance tax. Spain, there can be some provisions, particularly from parents to children, that can eliminate most of the estate, the inheritance tax, depending on which autonomous community you're in. France is a tough one. U.S. trusts typically are ignored or penalized in European countries, but it certainly depends on the jurisdiction, even the municipality. But we help clients work with their attorneys to draft cross-border wills, structure trust and holding entities, and minimize estate tax exposure so that your wealth is transferred smoothly and securely. I had a call with a client earlier today whose son was planning on either moving to Spain or Switzerland, and they're trying to figure out the repercussions if they structure their assets in a trust or if he would directly inherit them. So we discussed both options and which net impact would be if the parents passed and if he received their assets and what the tax structure would be. And the son also, he had a sister. And so how do we want to split those up between different retirement accounts and brokerage, right? And which countries really recognize that stepped up basis and the costs. And so a lot of this, right, is just planning on what ifs. But it's really important to do before we spend money on a U.S. trust or before we make maybe the moves ourselves, or if our kids are also expats, right? So we really need to make sure that planning's in place. And this is all really a part of our wealth management services. We have bespoke financial planning, including estate planning, like I was just mentioning, large purchase planning, income planning, savings plans, and really building up that wealth, right? We talk about the accumulation and then the distribution phase of life, aka working, and then retirement, just a fancier way to say that. We have investment management tailored to international portfolios, including multi-currency accounts. And then we look at the actual retirement account planning, making sure that your assets are in the right style of account, or if we even need to hold them into government styled accounts, right? That maybe in Spain we get a tax break because we have a 457 plan. That's just an example, not necessarily always true depending on your country of residence, but it's all part of our services to really take a look at. So if you're really ready to take control of some of your financial future as an expat and your investments, we'd certainly love to help. Again, please feel free to reach out on a personalized consultation. We review your current strategy, identify opportunities and efficiencies, and then build a plan and proposal that helps reach your goals and lifestyle while remaining within your risk tolerance. So thank you for joining today's webinar. I do realize it was a little bit shorter than some of my previous ones. We're going to be adding on to this pretty extensively, but I do hope that you found it insightful. Please feel free to ask some questions, or again, this link on the left is to really book with myself. My team is also one of the top purveyors of golden visas around the world, with a particular focus in Portugal. And so the guy on the team that is in charge of that, who does most Portuguese golden visas in the world, is Jason Swan. So if you have any questions about that, please use that link on the right. Let's go ahead and tackle some of these questions that people asked beforehand. The first one was one that I picked out because it's really important. Are there any special tax programs to be aware of? And yes, there certainly is. Spain, there is the Beckham law, right, which greatly reduces your tax rate, puts it to a flat tax, particularly with earned income. That's really the only way that you qualify for the Beckham regime, but it can be incredibly important for those moving to Spain. Another big tax program. There's been a lot of changes over the past few years, but it is still active, and it's NHR in Portugal. And it's NHR 2.0. They've made some changes. It's better for some people, worse for others, but it's certainly worth mentioning. There's a couple ways to actually qualify, as they made it a little bit more narrow of ability to actually qualify for the program, but there is an investment option to qualify. So it's a 250,000 euro investment option. 40% of that, I believe, goes into the S&P 500, and others go into both the Portuguese public markets as well as some venture capital funds within Portugal. But it unlocks this incredible tax opportunity in Portugal that, if you are high net worth or a high taxpayer, it can be certainly worth it. I have clients who that 250,000 will be worth it in one single year, but that tax program lasts for 10 years. And so it can be incredibly important to be able to unlock that, and it can save you hundreds of thousands, if not millions, for some. Let's take a live question next. I understand U.S. expats in France with U.S. brokerage accounts can hold ETFs without worrying about PFIC rules. Can they also hold U.S. domiciled mutual funds in U.S. brokerage accounts without worrying about PFIC rules? Thanks. This is a great question. It's U.S. brokerage accounts. We don't necessarily have to worry about PFICs. It's when you have a international investment account that can hold foreign ETFs. That's when we worry about PFICs. So the PFIC rules are really for international accounts. It's the PRIP rules that really apply to the U.S. accounts, which is why we are not able to have U.S. mutual funds. Now, We can hold those if we already have purchased them before making the move, but we can no longer use the reinvestment option for mutual funds, nor can we buy new mutual funds. And so we just can't add to those positions. We can still hold those depending on the mutual fund. If it's a proprietary fund, the custodian that allows you to have a foreign address may not necessarily be able to hold that particular mutual fund. So it's a little bit more of a complex question, but as far as PFIC rules, if your accounts are in the US, then you do not have to worry about that. So I hope that answers your question. What is the best way to transfer currency? Well, I mentioned this a little bit beforehand. I myself use a couple different methods depending on the amount that I'm going to transfer. I found that Wise is a really good way to move small amounts. It's very convenient. I have my business set up on there as well as myself personally, and it's extremely easy between USD and euros or other currencies if you wish. The others, Spartan and Smart Currency Exchange, can be great for large amounts, particularly if you're looking at that forward contract. Again, if you're looking at purchasing a property in 2026 or even in 2027, it makes sense to start planning. Speaking of property, and this is one that I certainly need to incorporate within the traditional webinar, if you're planning on selling your US property before making the move, we need to make sure that you're not going to be paying capital gains in your new country of residence. For most European countries, the tax year is going to be from January 1st to December 31st. And as a general rule, there are fine prints to this, of course, as always. But if you spend more than 183 days in your new country, then you're going to be a tax resident for the entire year. And what does that mean? Well, if you're selling your property in February and you have significant capital gains in that property, well, you might not necessarily get that $250,000 exclusion or $500,000 exclusion for married couples that you would get as a purely U.S. tax resident. So it's something to really make sure that you're paying attention to. Okay, let's take a question here from before. Can I still set up an annuity while living abroad? So on the surface, right, the answer is no. You can hold, it's similar to mutual funds, right? You can hold annuities as you are living abroad. We can use your new foreign address, but typically you do have to set that up while you are living in the States, or at least your primary residency is in the States, and you are there visiting that. And so there are some little fine print rules, right, that we could potentially get that set up for the particular scenario. Not going to be right for everyone. Okay, next question. What do you have for euro-based investments? Okay, well, we have quite a few. So to narrow it down, right, we can set up accounts that are going to be euro-focused or multi-currency, whether that be the Singapore dollar or the British pound, right? We have quite a few options there. There are some minimums to those types of accounts. I should mention my minimum is $250,000 to really start working on a full-scale portfolio. But there are certainly products that we can do on a one-off basis to be able to still make sure that you have some sort of exposure to the euro. A lot of those are going to be alternatives or simply not something that's going to be publicly traded. But there's a lot of good options out there for U.S. expats. Of course, we still have to be careful about PFIC rules, particularly when we are investing abroad. But there are some really good options. I would say private lending tends to be the cleanest, both on a tax basis in your new country of residence, as well as the US. And so that's certainly something that we've helped people before. Okay, next question. On a previous webinar, you mentioned that IRAs can't be moved abroad. Did this change? No. IRAs still have to be custodied within the United States. And that's really a hard stop to be able to keep that tax structure in place. Now, that being said, right, with different tools like a self-directed IRA LLC, we can still keep the IRA custodied within the US and use those funds to invest outside of the US. Now, again, there's some rules that go along with that, particularly the self-dealing rule, but we can set that up to make sure that everything is compliant on both sides. We do work with attorneys that are US based that do set these up on a regular basis. What investments are actually available in the EU for those funds, it is fairly limited. So I certainly want to warn on that. There can be some additional costs with this type of structure, typically a $500 a year maintenance fee, and somewhere along those lines for a setup fee as well. I'll let you, the attorneys, quote you directly on that. But it's certainly something that is doable for the right investor. Again, I've just had that request so many times this year that I've became very, very familiar with the process and those rules as well. Now that we're coming up on the half hour, we're just going to take maybe one more and call it a night. Again, please feel free to schedule in using that booking link, and so that we can go over your questions directly. Okay, so this is actually a follow-up question, which I try to spread them out, but these are such good questions that I certainly want to tackle it because it's something that I see all the time. Follow up to the holding ETF/mutual fund question for expats living in France. Side note, ETFs you can hold, mutual funds you can't. That's going to be the big difference between the two. Does anything change if you have a US brokerage and use a US address? Can you then purchase US domiciled mutual funds without worrying about PFIC rules? So if you use, financial institutions require you to use your primary address. So if you're going to be a tax resident in another country, they require you to use your primary address. Mail forwarding services using a family member's address isn't acceptable in their minds, and they can shut your accounts down for doing so. I've certainly seen it by quite a few of my now clients who became clients when they got letters from their institution saying that they weren't to shut their accounts down and liquidate their assets within 60 days. That's something that we want to avoid, particularly with retirement accounts or high capital gain brokerage accounts, right? That you're going to get a huge tax cost, particularly if you're a tax resident in the EU, when some of those taxes are going to be higher on both sides. And so you can until you can't, essentially, because they are certainly cracking down on a pretty huge basis right now. And so that's why it always makes sense to be transparent with your financial institution and work with someone who can work with you. Again, mutual funds, in my mind, aren't necessarily the best solution, both with their tax reporting and flow through, as well as their end of day transactions, as opposed to trading throughout the day, and their expense ratios. So don't need a heart, particularly on mutual funds, right? I prefer ETFs anyways, and we can still build those into your portfolio. For those of you who are watching the recording, this QR code will still work to book in with me. So please feel free to do so if you have additional questions. But with that, good night. Thank you for watching.